or so, a little bit less, and up at $86.48. So still holding on to those gains, that sort of breakout, if you like, since last week. Ever since I think the IEA basically said, we're revising demand upward again for the fourth time in as many months. Let's go straight to the ground of the biggest gathering of oil and gas industry thought leaders and leaders in the world each year in Houston at CERAWeek. Andrew Critchlow, head of news, EMEA region for S&P Global Commodity Insights, which of course are the hosts of the grand event. Andy, I mean, where to start, but what's your big takeaways? What should we know with what's going on in CERA that might be relevant to the oil markets?
Yeah, well, I mean, the big breaking news here, early in the morning is an exclusive story that we broke at S&P Global Commodity Insights based on a letter that we obtained, directed, and you mentioned the International Energy Agency and its changing forecasts. Well, this is a letter that was written to Fatih Birol, the executive director, from two very prominent US Republican senators and lawmakers that sit on very influential energy committees in Washington. And they were, this is a very hard-worded letter criticizing the IEA for its peak oil demand forecast, which of course the IEA is now saying that we could reach peak oil as early as 2030. Obviously, that's driving a lot of investment decisions, a lot of decisions at a government level within the OECD around energy transition.
Of course, S&P Global Commodity Insights has also called 2030 as peak oil demand.
That's true. The difference is that we're an independent company, whereas the IEA is an official intergovernmental organization. It is in a way it's like the NATO in terms of energy and commodities. It is an international watchdog, so it has huge significance in the investment community. So in an election year, this is massively significant. And further to this, these senators, these Republican lawmakers, are actually asking for details on the US funding to the IEA. And so it does
more sanctions. Let's sanction everybody.
Well, it opens the possibility, when we're going into an election year, and it does open the possibility that could the US withdraw from the IEA? Could it withdraw its funding from the IEA? The significance to CERAWeek is that the conference opened with a very robust defense of hydrocarbons, a very robust defense of fossil fuels. This was started by Amin Nasser, the CEO of Saudi Aramco, calling the phase out of fossil fuels, of oil, gas, a fantasy. And, really, we've seen a succession now, the CEO of ExxonMobil, Total, Shell, BP, Conoco, Chevron, everyone's jumped on this wagon that was set off by Aramco, saying that, we need to, take a pause. And actually, we need hydrocarbons. We need to be producing more oil. Aramco saying that by 2025, they see a market of 105 million barrels a day plus for oil. We need more investment. Stark contrast if you wind back to 2021 at this conference, no one wanted to mention oil. It was a dirty word. It was so energy transition focused, so decarbonizing focused. So a dramatic.
I suppose that's what happens after you earn $100+ billion in revenue, in profit over a few years. You get a little more confident. Kieran Gallagher, welcome back. Kieran Gallagher, Managing Director, Vitol Bahrain. Just coming back to the immediacy of the markets, Kieran, this thesis that I've been sort of challenging and putting out there over the last week, that this is a breakout from the tight bandwidth of the oil price, the front month that we've seen for most of the year, that the sort of 78 to 82 or whatever it was that we were moving up and down in, that we've now broken out with that as we look towards the second quarter, the period in which demand just naturally grows annually, that this is a breakout to the upside looking towards the second quarter. Your thoughts of where we're going with the current oil price now?
Yeah, good morning, Sean. Well, it's been supportive. There's been an element of geopolitical risk inherent in the market for a few months now. What I would say is that the fundamentals have got a touch tighter. We're seeing continuing attacks on Russian refineries. We're seeing the latest on the Lukoil refinery took out another 150 kbd a day. We're seeing supportive transport fuels market. We're seeing a lot more oil and water being rerouted around the Cape. All of these things, taken together, along with the geopolitical risk, means we're not really building in the pricing centers. And when we're not really building anything in the pricing centers, the market becomes more backwardated.
What does that mean, just for the clarification, building in the pricing centers for the non-initiated?
We're not building it. We're not building any stocks, really, and that's been a factor. We are seeing a growth on oil and water, but on land stocks, we're not really seeing that growth. And
we did have the Energy Secretary in CERAWeek say that they plan to restock by the end of the year. It seemed strange given the price level, but she did make that statement.
Yeah, I guess that's very price dependent, right? We have seen that happen and big price dips, but as you say, from edging up from the 85 towards the $90 a barrel market, it's questionable whether we see that following through on whether we do see that stock rebuild. But I think there's just been a number of factors in recent weeks that have added a little bit of further support, and I guess a belief in the $85 a barrel market, and therefore I do agree with this small breakout as it seems to be gaining a little bit of confidence. Yesterday obviously there was that sell-off. I think that was more Fed related than fundamentally based, but yeah, I think there's a belief there that we could be in the 85 is somewhat not a base. We'll always see dips, but more confidence in a higher price oil market.
Mike McGlone, senior macro strategist at Bloomberg Intelligence, just picking up on that point from Kieran. The big Fed non-announcement yesterday ultimately, but sticking with its guns, I suppose that there will be cuts in the second half, and certainly the sort of risk on equity markets love that. Gold a little bit concerned though that that they might be buying into inflation for the long term.
Well, I'm glad you went there, because as a commodity guy, at least I want to talk about one major commodity that's going up and I expect to continue to go up, and that's gold. It was nice to see that in the headline this morning on Bloomberg Terminal. All you hear about is record highs in the S&P 500. We have a record high in gold in terms of dollars, and I expect that to continue. I enjoyed writing a gold crosses deck last week. I compared gold to everything, and it's continuing to break out, particularly versus crude oil. Crude oil is completely subject to the U.S. stock market going up. To me, that's the number one issue right now. If you look at a value at risk model, you're managing your crude oil positions, which is mostly levered futures. S&P 500 is up 10%, crude oil is up like 15% or so this year, and I think the risk is just a little normal reversion, which you haven't had a correction in the stock market since the low, more than 1.5% on a weekly basis. Then you look at all the macro. The key thing that's really been driving the pressure of crude oil and most commodities to go lower in the last 15 years has been massive excessive production out of the U.S. and Canada. That's continuing. The average cost of production in the U.S. is around $55 a barrel. We have record highs in supply and demand is declining. Diesel demand in this country is the same as it was about 10 years ago. Unleaded gas demand isn't picking up. And you look at, I think I'll end with this. I think natural gas is what we should look at as an example for all commodities. They have to get below the break-even cost before they're going to bottom. Corn's got pretty close to doing it, and I think begrudgingly crude oil's rallying here, but the risk is it still drops towards 50 or lower in the U.S., particularly if the U.S. stock market has just a little normal 10% correction, which used to be normal.
Mike, just to pick up on that, what does the record, I mean, the gold price is hitting records just today, but also it has hit a few records in recent weeks. What does that tell us? Is there a cuckoo in the coal mine there? What's the gold price telling us when it reaches record levels?
I think gold is clearly reflective of the changing world order. It started with the unlimited friendship and how the whole world has shifted, with China going over to kind of creating the four bad guys: China, Russia, North Korea, and Iran. And the biggest pockets on the planet, most notably central banks, China, are buying gold at a colossal pace, according to the World Gold Council. At the same time, we've had significant outflows in gold ETFs. Now, they might be starting to tick back up now, but gold is the alternative to the dollar for most of the rest of the world. And the dollar is strong too, but I don't see anything to stop gold technically and fundamentally from continuing to go up. Yeah, it's going to have corrections, but it's the main alternative to all this wealth that's created in the U.S. stock market. And we know at some point we're going to tilt towards a recession. And I look at things that used to matter. Leading indicators are still negative in this country. The curve is still inverted. Diesel demand, I mentioned, is declining. And then you look at a thing I really liked publishing last week. If you just look at the U.S. interest rates, the 10-year note yield is compared to the top other four in the world, China, Russia, India, Japan, it's still about 100 basis points higher. That's the tilt. The rest of the world kind of still shows that recessionary tilt. Only China started cutting rates. Typically need a long and variable lag to rates. I see Europe tilting towards recession still. And U.S. is shining star, but we have an election coming up. And there's a problem also. The key thing is what you're hearing from the Fed is significant, but for them to ease rates with inflation above their targets, kind of following the uptick in equities, have that wealth effect, would be considered irresponsible. Yet the market's price
and oil going up to 90, that would be another kind of inflationary piece. Andy, I wanted to get some insights, if you have any, from the ground in Texas. Are they going to be pumping more oil in the Permian? I mean, that's a big question this year. We saw the U.S. add a lot of barrels last year. They seem to have had a sober start to this year. Any word from the ground there? Do you expect more money in the ground in Texas?
Yeah, I mean, that's definitely some of the mood here. I mean, we had Mike Wirth, CEO Chevron, saying the other day, I think that they're about 800,000 barrels a day at the moment in the Permian. They definitely expect to go to 1 million in the next 2 years. There's a lot of investment going into that, and I think that that's pretty much analogous across, all the major IOCs here. There's a lot of M&A activity, of course, here in the US. A lot of investment. Of course, we had a record year for US production last year. I think 21 million barrels a day, in excess of that total liquids. And I think we're forecasting internally for that to go higher. And I think a lot of that's driven by M&A. We've talked about it before. Exxon aren't going to go and buy Pioneer and just sit on that asset. They're going to want to, maximize their returns. To do that, you're going to produce more oil. We've heard from, both of the other guests here about expectations for higher prices above $85 a barrel. Interestingly, Kieran, we heard from your boss, Russell, the other day, talking about another 100,000 barrels a day of fuel demand from additional shipping routing around the Cape of Good Hope. A lot of geopolitical risk. Interestingly, here on the ground, very little talk around issues that if we run things back to IE Week in London. I know, Sean, we were there a couple of weeks ago, London Energy Forum, where there was a lot of talk amongst the trading community around the price cap, whether we'll see tougher sanctions on shipping, etc., whether we'll see actually the price cap coming down. We had Kadri Simons here on a panel. She's the EC Energy Commissioner with Amos Hochstein, President Biden's energy envoy, specifically really with a focus on the Middle East. No talk of Russian price caps, no talk of sanctions, very little talk actually of the election. It's almost as if people are kind of saying what they want. A lot of concern around permitting, a lot of concern obviously around what happened with permitting LNG export terminals and the moratorium on that. So a bit of a wait and see pattern until we get to the end of the year, we get this election, and then whether it's a new administration, whether it's the Biden administration continuing for a second term.
We'll have to certainly see on that one, and there's obviously some steps to be taken by that administration. Indeed, that it seemed a little odd that the Secretary of Energy would have mentioned buying, refilling the strategic reserve at this time, which would be an upward move for prices, which of course they wouldn't want to do during an election year. Kieran, I wanted to get your thoughts on where we're at. I mean, while we had a soft, well, not soft, obviously, the average oil price for Brent during the first quarter was pretty solidly above 80, but 80 or thereabouts. But there was an expectation and was a tightness emerging in the middle distillates in gasoline, diesel. Now with these events knocking out the Russian refineries, what's the outlook, do you think, for distillates in the second quarter, and how tight is that market looking?
I think obviously with middle distillate, with gasoline or diesel and jet, you obviously see a usual east to west flow. The LR2, LR1 market, we typically seeing non-Red Sea flows from the AG, West Coast India, etc. We're seeing 78% of those vessels diverting around the Cape, and therefore that sort of sentiment naturally gives a bit of a lift to the market. And as I said to you earlier, that in conjunction with the fresh attacks on the Russian refinery sector has obviously given it buoyancy. That said, that disruption started really happening to those flows from middle of December onwards, and it's January, February. Those deliveries have now sort of started to normalize again, so you're still getting LR2s hitting the market every couple of days, but we're not seeing any change in pattern. That's a big thing, whereby those vessels continue to route around the Cape. We are going in, even more local to where I'm sitting. We're going into a period of Persian New Year, Easter holidays, and Eid holidays, and therefore the demand for transport fuels amongst those three big holidays around sort of Middle East, Mediterranean, etc., gives a bit of a lift in itself. We're seeing jet fuel now back to averaging around 6.9 million barrels per day over the last 4 weeks, which is back at 2019 levels.
Which, of course, is a global number.
It's a global number, and at 6.9, we see growth in Q2, which brings it up to sort of record highs. So the outlook for products is okay. The one caveat against that, I would say, is we are seeing relatively healthy production from the new Middle East refineries in Zohr, Duqm, Jizan, and therefore that's adding a little bit of weight to the diesel market here. So despite those reroutings, the overall sort of diesel fundamentals looking a touch heavier because of that additional supply year on year.
I wanted to follow up, Kieran, on what impact the tighter sanctions. I mean, Andy said nobody's mentioning price caps in Texas, but there has been a tighter restriction on shipping by the implementation of the G7 sanctions, and we've seen a big reduction in the number of fleet, the available fleet for the sort of gray market, if you like. What impact is that having on the volumes reaching market?
Well, it's tricky to do an accurate cargo count, but the analysis we do, we are seeing a lot more Russian oil on water. And that means whether it be on sanctioned ships or generally, sanctions tightening and this oil struggling to find its way into end user homes. So we are seeing a little bit of a build up on that over the last month, particularly on the clean product side. But what that is doing, because of the additional ships that have been named and sanctioned, we are seeing an incredible spike in the clean tanker market. Just in the last 36 hours, we've seen a fixture of $8 million being fixed from the AG to the west on an LR2, which is a fresh high. We're seeing vessels coming from Latin America taking fuel into the Middle East and cleaning up. So we're seeing an increasing amount of dirty boats cleaning up into the CPP sector because of the earnings available in that sector at the moment, which again are incredibly high for this time of year.
Mike, just again circling back to the comments, I was listening to the full press conference by Fed chairman early this morning, and he seemed to be kind of juggling between the dual mandates, right? The full employment or as much employment as possible, and price control and inflation control. And I started to hear sort of cracks in the thinking there that they might be willing to compromise on price control, i.e. controlling inflation, if they see job numbers starting to look uncertain. Your thoughts on that outlook and the Fed's willingness to compromise on inflation because jobs might start slipping?
Yeah, and I think that's a good observation. It makes sense. Inflation's bumped up to near 4% from around 3.4, 3.5%. Typically, that means it's going to continue higher. And the history of unemployment bumping up like that is that
because unemployment is still below 4%, which is sort of near record lows, right?
Right, and it just never bumped up without going to say 5 or 6. So it's going there. It's just a question of how and when. I think he knows that. All my analysis shows that. All the leading indicators, yield curve, disinflation trends are going there, and we're heading towards significant disinflation if history is a guide, after having the biggest liquidity pump in inflation in history. And
which we seem to be seeing in goods and hard materials, but not in services, right? That seems to be the dichotomy.
Yeah, that's the key thing. So it's a matter of time. A lot of that's still the hangover from the recovery from the distortions of COVID. And that's the key thing to think about is, I like to say, is this commodities are clearly deflationary. Natural gas, one example, crude oil is the same price as 2007. It was well off the highs. And I just don't see a lot of upside there without currency debasement. So there's where gold's kicking in. But what you just described is a very unique situation. And the way I look at it is the bottom line for the Fed is it's a unique environment. We can't really cut yet, partly because inflation is above their targets, and we're seeing significant speculative frenzies in commodities, and not so much commodities, but cryptos and equities, which is bumping up that wealth effect. And I think that's the key thing. I think the trigger for the first ease will be when the stock market has its little drawdown. Like what used to happen is 10% are normal drawdowns.
It felt to me like he was trying to put pre-message justification for a cut based on a concern for jobs rather than continuing to tackle inflation. That could come in the second half. Let's go to the survey question today, which is addressing some of the points we mentioned, which was the oil demand growth forecast. This recent sort of breakout, as I call it, sort of seemed to be triggered by the latest IEA revision upward in demand growth forecast last week, which was the fourth since November. But ultimately, this one seemed to be the one that kind of broke the current vase, if you like. And my question is, will that upward revision trend continue? One, yes, through Q2, we'll see the IEA revise again upward demand growth and close that gap with OPEC, which of course is, it's still about 1 million barrels of separation between the two in terms of demand growth forecast. IEA will continue, yes, through Q2 and 3, we might see the IEA revise demand upward, or no, 3, they're done now. That's it. They've got it wrong 4 times. That's enough embarrassment. Which of those do you think is the rock and roll on that? Andy, looking ahead, obviously you're wrapping up CERA Week there in Texas. Big takeaway for you? I mean, Amin Nasser's comments, while certainly quite strong, that's sort of preaching to the choir, really, isn't it? You wouldn't expect him to say anything else. I mean, a bit of hubris maybe creeping into the oil and gas industry at the moment. But what's your big takeaway from Texas?
More drilling. That's all I see here. I just see the IOCs are definitely going into, maximizing returns, more drilling. You're seeing all this M&A that has to be paid for. Oil at the moment is so accretive for them. New basins, Guyana, there's so much talk around the potential offshore Guyana, so much talk about new capacity, new production that's going to come in, non-OPEC, here in this part of the world. The big question obviously is how long can OPEC keep this 5 million barrels a day of spare capacity off the market? Watching.
What's your own thought on that, Andy? I mean, it does seem that Rystad were saying in IE Week that they thought they could bring some back from the middle of the year?
I think a lot comes down to Russia here. And because that 5 million barrels of spare capacity, that's opened up the arb, it's opened up the opportunity for Russian Urals to come into Asia. Now, of course, that trades at a discount, but as we discussed at your events on the fringe of IE Week in London, that this market share battle, which has been parked to one side, it's already started between OPEC and between the OPEC Middle East producers, Saudi Arabia, UAE, Kuwait, for those Asian markets with Russia. Because that Urals was 2 years ago, that they weren't in that market. It was Europe, right, in the Atlantic Basin. So how that plays out is going to be interesting. And of course, Novak 2 months ago was saying we are not going to have an export ban on diesel. We are not going to have an export ban on transport fuels. Well, now you've got about 1 million barrels a day of Russian refining capacity that's suddenly been knocked out. We had a month ago, you had Russian cargoes of diesel landing in Brazil. Can they still do that when they've got, domestic going into the summer, it's planting season, etc. Can they still do that when, they have a big draw on fuel domestically in Russia? So that I think, watching that market very closely at the moment.
Kieran, I wanted to get your thoughts on a story we're carrying in the digest today, which is a report by Oliver Wyman that commodity trading's coming of age is the headline of their report, but ultimately they state that commodity trading firms like your own and are sitting on about $100 billion in retained earnings. And they put a very broad spread there of ideas. And now that you are on the board, management board of Vitol, and congratulations on that, you can maybe give us some, not obviously your in-house thinking, but ultimately, what does it mean for the markets as a whole, or for the direction of you and all your peer groups when there's so much firepower, so much cash available? What does that look like? What could that impact the markets?
Well, I think, there's no secret. There's been, it's clear to everyone there's been incredible volatility over the last few years from COVID kicking into the present day, and trading companies enjoy volatility and have largely done well, as can be witnessed by the published results. What it probably means, Sean, is that you will see trading companies invest some of that those retained earnings. You've seen Trafigura make an announcement on acquiring Greenergy or going through that process. We recently have made an announcement ourselves on taking over a share of Saras refinery in the Med. I think you're going to see some trading companies acquiring more assets, and I don't think there'll be a big switch to asset-based trading, but certainly a little bit more exposure in that area.
Do you think that could include do you think that could include upstream as well?
It's always been a tricky area for trading companies because drilling can come to nothing, right? And it's
traders don't like nothing. We know that.
Exactly that. As Vitol, we've had venture ventures in the US, and we have had exposure to the Permian through an affiliate over the last few years. But it's never been central to either ourselves or the other main trading companies. It's never really been a central investment theme.
Well, I would say it's an interesting report, worth reading. It sort of triggers some ideas, and the one thing it notes, which is that this windfall of retained earnings, is sort of cash, comes at a time when we're seeing a lot of leadership change in the big trading firms, and so you've got this both big cash and new vision. Be interesting to see where it all goes. Mike McGlone, last word to you. Looking at obviously we're getting fully squared into the election cycle now, the two candidates selected more or less and so forth. Is that going to impact the markets anyway? Should we be alert to the political, the policy, the declarations, or will that just be all noise on the sideline?
Yes. It's going to
Yes.
be a lot of noise. But
It's-
I enjoyed at the Greenwich Economic Forum in Miami last week. I enjoyed moderating the panel about that main subject. Will Trump be elected? And what does that mean? I mean, it's the key question. And the bias is right now, the trend is will be reelected, unfortunately, which probably means drill at will. It's bad for prices, maybe good for profits in the energy sector, bad for prices. And I think it's a continued bid for gold in terms of commodities. Everything else is, that's a big one.
It's a wait and see. Well, certainly the idea of, we've seen in previous cycles, whether one can jawbone the gasoline price at the pump down. At the moment, they look that their digestible levels, $3 and change. Doesn't seem anybody's going to freak out too much about that. But if they got up to $4, then over the summer, that might be problematic. The view of this room is that, yes, we're going to see more revisions upwards on demand growth by the IEA through the second quarter. There's even some views that could go through to the third quarter. And there's some views that no, they're done now. And certainly the direction of that could continue to give a lot of upward momentum to oil prices in the second quarter. If indeed we did see the IEA continue to revise their demand forecast upwards, we'll have to wait and see. But until then, thank you so much, Kieran Gallagher from Bahrain. Really appreciate it. Andy Critchlow in Houston and Mike McGlone in Florida. Really great to have all of your insights this morning. Thank you very much. We'll catch you all soon again. Bye-bye.
Bye-bye. Thank you.